Hi, everyone. I'm Rick Bensignor. Today is Tuesday, December 8th, and welcome to this week's In the Know Trader show. As we record late Tuesday morning, the S&P has come back from being down for the bulk of the morning. It is now up about 5 points. The Nasdaq is down 30, the NDX is down 31 points. That's about 0.25%. Russell's up 0.5%, and the Dow Jones is up 0.3%. So we kind of have a mixed market. The 10-year is down just over 1 basis point, just about 91 basis points. Crude oil's down 11 cents, so pretty flat on the day. And dollar's up 16 ticks. Gold is also up, even though the dollar's up. It's up about $7. And silver is down 10 cents today. So today what we're going to do in the show is, in our trader education portion, we're going to look at using multiple indicators showing, for instance, a support level as compared to just one, and the advantage to having multiple indicators show up when you want to be a buyer or a seller. In our market overview, we'll take a look at the US dollar, which has continuously weakened, and how it's helped affect gold and copper. And in our sector analysis portion, we'll take a look at a group we haven't looked at for a while, which is the Consumer Discretionary sector. So we'll look at the XLY, which is the macro spider ETF for Consumer Discretionary. And then we'll look at, 10, 12, 14 names, whatever we can get to, starting off with Amazon, which is the biggest of all the Consumer Discretionary names. In fact, it's about 22% of the index. So, you always got to know what Amazon's doing if you're looking at Consumer Discretionary. All right, so let's start off with, let's just go one more slide and remind you about the products we have. Our weekly Etf report called The Tactical Trader comes out Wednesday nights, reviews everything going on in the markets, especially a deep dive into the S&P. And then each week gives a new ETF trading idea and updates all the other open positions we have. That comes out Wednesday nights. Then on the last day of the month, typically, we come out with our 7-11 monthly Spider Sector ETF report. Again, the goal of that is to outperform the S&P. We've been doing that now for 4 months, and as of December 1st, we've outperformed the S&P by about 1.9%, so just shy of 2% in 4 months. Annualize that, you get almost a 6% outperformance relative to just accepting the plain benchmark return. And that is a huge difference. If no matter how much money you have invested in the market, if you can outperform the market by 5% simply by being more of an active portfolio manager and staying away from the sectors that are underperforming, you will do far better over time. And that is what that report is. Again, comes out monthly, generally on the last day of the month. Okay, so let's now take a look at some charts, and I want to start with, so let's get to this idea of kind of using multiple indicators. So let me just find a place here. Let's start with something like, all right, so obviously Slack recently got bid for by CRM, Salesforce, and it's had a huge move up. And of course, I had no way of knowing this was coming, but I recently bought it myself, and I bought it, and here's kind of the point of having multiple indicators. I do know that markets can often turn on nines. In this case, a 9 up topped the market. Here's a 9 up that did not top the market. Here's a 9 down that helped bottom market. And it was right in here that I bought Slack for myself simply because I'm going to blow this up now. Take a look. Besides a 9 down, I had a propulsion exhaustion signal just beneath the 9 down, so kind of the day after price action, and a TDST level These are part of Tom DeMark's models that we use. So the TDST line, this little dotted line, is the lowest low in the 9 count up. And they happen to be just purely unrelated, that they came, the propulsion and exhaustion signal happened to be virtually the same price that the TDST line was. So now I kind of have 3 unrelated reasons to be a buyer. And of course, it was towards the lower end of the range that we had seen. So I kind of had multiple reasons. If I look at RSI, I see a fairly oversold RSI at the same time this was happening. So now I have 3 or 4 reasons to come and buy this stock when and where I did. And again, I had no clue that any of this was coming and that I'd have such a dramatic win so quickly. And I actually sold some against this level here, which was the propulsion exhaustion level on the upside. But I still have 2/3 of my position, and now it's going to start trading fairly flat because, you know, this is a takeover stock, and it's already been announced how much the proportions are of how much CRM stock you get and so on. So I'll probably, I could either leave it here, I could sell out before, and, you know, just take the current price, or I could end up having a transfer of shares and also owning part of CRM because you get some Salesforce shares for every Slack share you had. But the important thing here is that I had multiple reasons to be a buyer, not 1 or 2, which is so often how people make their decision is a market will pull back to a trend line or something like that and say, okay, let's buy it against the trend line. And the trend line may work and maybe it does bounce off of that. But if, let's say I was trying to lean on a trend line and I also had a 9 or a 13 down to say downside exhaustion of trend, and a piece of the cloud as potentially being support, or a TDST line or a propulsion exhaustion level, or anything that gives me multiple reasons to be a buyer, I'm going to feel like I have a much better chance that this idea is going to work. And the reality is it's either going to work or it's not going to work. You don't know when you first get into something. But I know I have much more confidence that the idea is probably a good idea, a sensible idea, if I have multiple indicators showing up in and around the same place that I'm looking to be a buyer. And sometimes it could be as simple as, you know, a trend line that just by chance happens to match up with a 50-day or a 200-day moving average. But that at least gives me a couple of reasons to buy. And then again, all these other things that I mentioned. So that was just a recent example of something that worked out for me simply because I had multiple reasons to be a buyer. Back in, let me see, I know I paid 32, so it was down here. Back in June, I bought Pfizer, and I bought it based upon this exhaustion level in here, coming right very close, $1 or so away from a TDST line. And if I remember correctly, I actually ended up buying Pfizer 1 day before the low was made. I bought it this day, and I still have Pfizer. And you know, now it's up here. It's in the news today. The vaccine is actually going to be used. It's got good efficacy, and you know, now I can at least target something up here to potentially take further profits. What else did we buy recently? In the No Trader, we bought MJ, which was a marijuana ETF, and I think I've probably told you before, I have never tried marijuana in my life. I typically do not buy stocks like this or Philip Morris, but I just, you know, in this case, I just saw enough reason with, we got into this, I think it was actually off of the weekly chart. Let me see. Yeah, double bottom, 9, kind of same place. We had a 9 here. The 9 and 13s were together. I'll blow this up a bit. We hit a propulsion exhaustion level, and we got in, if I remember, in maybe mid-October, a couple weeks before the elections, and simply because I liked the 9 count on the weekly against a propulsion level. 2 unrelated reasons that are counter trend with a potential double bottom. That's 3 reasons with a RSI that's testing where it had gotten oversold prior. That's 4 reasons to have stuck my neck out, as well as the fact that I had a feeling that pot stocks had kind of seen as bad as they were going to, and if there was any chance that the Democrats were going to win, it would probably help lift the sector. And sure enough, you're seeing more and more states legalize pot, and therefore the ETF that tracks it has done well. I also bought for myself, so that's something we did in the No Trader. For myself, I had bought, and this again was the first time I had done something like that in a space like this. I bought Aurora Cannabis, if I remember, I paid, yep, right here. So after knowing, seeing a double bottom, right? So here's a low accompanied by 13. Here's another low several weeks after 13, but similar region, big move up. I bought the pullback. I literally bought the propulsion exhaustion level. It was 640, 650. I paid 652, and I still have that. So I'm looking to get up here towards 15 and a quarter-ish. It's a TDST line, and unrelated to that, you happen to have the bottom of the cloud. So now I'm going to probably run into some trouble up there. I'll take some profits there. So the point of today's lesson is just the more indicators you have that are unrelated to each other, that show you either support level or resistance level, the better you should feel about playing against those levels as compared to just leaning on one particular indicator. I generally, I'm not going to buy something because it hits, let's say, a 50 or sell something against a 50-day moving average. It's just one thing, and maybe it's going to work and maybe not. But if I have multiple reasons that right near that 50-day average is also a propulsion target, is also the top of the cloud, so that should be resistance, is maybe an old high. Now I have 3, 4, 5 reasons that I can make sense about doing what I'm doing. And that's the point of today's lesson. So hopefully that'll mean something to you as you go forward and look at your own names that you trade and new names that you get into, and when you get out of them, should have multiple reasons to do so. And those can include fundamental things too. I'm not saying it has to be all technical, but you want to have multiple reasons to make the decisions that you do. Okay, let's go back here. So what did we say? After we talk about this, let's take a look at the US dollar, gold, and copper. What we will do before that is take a look at how the sectors have done week over week. So let's get here, and we see lots of colored dots this week, whether they're red or green. So it means that the S&P sector, these 11 macro sectors have moved 1% or more in relative terms to the S&P since last week. Red dots mean they have fallen by 1% or more. Green dots have moved above. So we've got 1, 2, 3 sectors outperformed over the last week. 1, 2, 3, 4, 5, 6 sectors underperformed last week. So we're getting some broad movement in the markets. Energy has gained back, but look, it's still down by, what is that, 40? I can't see if that's an 8 or that's 46. So 47%, still a terrible underperformer. Tech is now only, here's tech here in bright pink. Magenta, it's up about 23%. So it's well down off of how much it outperformed over the course of the year, but it is still the number one sector. And you'll see here that consumer discretionary and communication services are roughly the same in outperforming. And you still kind of have your laggards here in the interest rate sensitive area, which are your utilities, financials, and real estate. So besides energy, that's the sector. Those 3 sectors have done poorest this year. Okay, let's take a look now at some charts. So we will get to, let's get to the dollar. The dollar's continued to weaken. And here's the weekly chart. So this purple line here goes all the way back to 2011. This was the key uptrend line that we kind of saw the dollar hold onto, not only this time here back in the summer, but then for about a month. And then recently, last week, we really kind of materially broke down. And so that level it has broken. Now you still have the dollar having made lows back in 2018, down in, just a little bit beneath where we are. In fact, this whole area in here is where it built the base before it started heading higher. So this yellow box in here is kind of represents the TDST line, the lowest low in that 9 count here that started out of there. So that's where the real support is. So we've got some getting close to where the dollar is, and then what I expected to be the my minimum downside target for 2021 for the dollar is this level here, and that's just about 87.40, give or take, somewhere right around there, and that's where I think the dollar is heading. So I look at the move off of this year's highs, and this year's highs came in March when stocks were falling apart. So I look at that high and pretty much a straight line down into this 9 here. It was a little consolidation, but I think then the bounce stopped right against resistance where we had seen prior lows. So we came right back up against resistance, broke down to new lows. I think we're minimally heading down here in 2021. And therefore, that keeps me bullish the gold market and bullish any of the commodities that are dollar sensitive. So certainly silver, platinum. Platinum, in fact, just broke out this past week, finally, to new highs. And that part of that is the effect of the dollar weakening. So that's the dollar. Let's look at gold. Here's a daily chart. So here's your all-time high. I think, let's see, yeah, it is a daily chart here. This is gold futures. Let me see what, just curious what I have for that purple. I don't even know what that was, but I'm going to switch it to a weekly chart. And so let's see, what is, so that was the old highs near 1800. I was just curious what the purple line was on the chart. So we knew there was some support around here because that is where gold had peaked 3 times in 2011, 2012, once the all-time highs in 2011 was made. And I actually bought some gold for myself last week, right near this low. There's so many different ways to buy gold. You can buy futures, you can buy GLD, the ETF, you can buy IAU, which I believe is the SPDR ETF for gold. There's PHYS, which is an ETF that's Sprott Physical Gold. They actually buy the gold itself and store the gold. A lot of the other ones are much more, you essentially have the right to the gold, but some of these funds don't actually buy gold. PHYS is one of the ones I prefer because they literally own the gold in vaults, and therefore you know that you actually own gold and not just a paper receipt for gold. So I bought a little in, here I'll actually show you, I think, PHYS. Yeah, so I bought this propulsion exhaustion level right here. That level is 1383. I remember I paid 1388. So, I've got a good bounce. And there's going to be some resistance gold right here from the cloud chart. So this magenta colored line is the midpoint of the last 9 bars. And it would be considered the first level of resistance, and there's going to be multiple levels. But if I'm right that the dollar continues to break down, then I'm willing to have bought some here. And even if gold falls and sells off more, that's okay. I'm building back into a gold position over time. So this was not even meant to be a trade. It was meant to be the beginning of a position. That's why I bought a small amount, not the full amount. And look, if I use just my own signals, this could easily turn into a 9 down, somewhat lower. And I wait until I get a 9 down, excuse me, and if the 9 down actually coincides with the cloud, then I'll be a much bigger buyer. But at least I wanted to dip my toes into like a known downside target level in order to get some more exposure in gold. All right, so that's gold. And then we said we take a look at copper. So let's pull up a copper chart. It does not look like copper. Ah, that's a copper chart. Okay, so copper has been steadily moving up since. If you look at this chart, it's not so different than the S&P. Bottomed in March. It's moved up to the best levels. The only difference is this happens to be on a combo 13 right now, so it would suggest that we're towards the end of the run before we'd see a possible pullback. So I don't want to buy copper up here. If anything, I start getting a little more aggressive, anywhere from where it is now up to, what is that, 365 is a place to probably lean on. So if I'm also on a weekly 7 count, in a couple weeks, I'm going to have a 13 and a 9. And if it's up here, I may even, put on a speculative trade to short some copper. But copper is very much like the market now. And you can see it somewhat climbed up the magenta conversion line of the cloud chart. It's a very strong chart. Rand stops through the highs of 2018. And it's something to watch. And most of you don't trade copper, but there are copper related stocks, something like Freeport Mac, FCX is a copper related stock. What else is there? I'm trying to remember back from years ago. Southern Copper, I think. There's some Peruvian related companies. Vale, if I remember, VALE, if I remember, was a copper related stock. So just other ways of potentially playing copper without actually playing the commodity itself. All right, so that's that. Now let's move on to this week's consumer discretionary sector. So let's start off with the XLY. So here's the chart. It's a weekly chart, and generally will stay in the weekly time frame. Most important things, look, 9 up here, pullback, holds the propulsion. These dark purple lines are bearish levels that if you properly close underneath would suggest you get down to the next level, which is the propulsion exhaustion level. So this is called the propulsion momentum level. Bounces off of it. Did it again here. 13 makes me skeptical. If we really properly break this, it could go well lower, but all it was a minor pullback, and now we're getting close to some propulsion exhaustion signals on the top side. And the risk level is up at, 161. So up in here, same thing, I'm kind of somewhat hesitant to be a buyer here. I've seen the last couple times down, bounces off of propulsion levels, so maybe it would happen for a third time. So if we got down maybe to here, I'd be a better buyer than chasing after here. Obviously, we're pretty overbought. You can see how much this looks like the copper chart we just looked at. So the stock market and the copper market are very similar these days. And both kind of suggesting to me that I don't really want to chase much after them here. But even notice, here's something interesting I just noticed. From this low in whatever the state was, where is that? The week of October 26th, each weekly low has subsequently been higher. So there's some real demand here. Look, every low is higher than the prior weeks. And even though you don't necessarily have higher highs, you've had higher lows. So it shows real demand, but just up in here kind of makes me feel like I don't want to chase after consumer discretionary stocks. Again, Amazon is 22% of this. We'll take a look at its chart in a moment. Home Depot is 11%. So those two stocks are already 33% of this whole XLY. All right, let's look at Amazon. Here's the weekly chart. I will tell you I own Amazon, and in fact, my wife works for Amazon Web Services. So yes, I have an interest in Amazon, but nothing I'm going to tell you has anything to do to the fact that I own the shares. I'm always completely upfront with you guys and just tell you what I see. What I see is double top, kind of rounding top, hasn't broken down by any means, and I probably wouldn't be concerned until it took out 2814, which is the weekly propulsion exhaustion level. So right now it's just going sideways. We're a few weeks away from potentially getting another 13 on the top side. In fact, if I put an aggressive sequential on, we may already have one. Yep. So that already came actually on the week that made the all-time high. So it hasn't been able to advance since there. Upside targets are 35.75 and then almost 4,000. Downside, I guess you can say some light support at 30.30 currently, then 28.14. And if it breaks that, the cloud itself should also be support. Notice the last few times down to the weekly cloud, the cloud held the sell-off. The cloud held the sell-off. The cloud held the sell-off. So this cloud has been important. So you probably have to come down through the bottom of the cloud in order for this to really have the chance for institutions doing more significant selling. All right, Home Depot. Interesting right here. So this week, what had been dashed lines turned into arrows, which means this actually gets a propulsion sell signal. It's qualified and confirmed. It would suggest that Home Depot is headed for something closer to 240 on the downside from the current 260-ish. On the other side of that potential analysis it'd be interesting to me to see how we close this week and next week relative to the baseline, which is this kind of yellow colored line here, which is part of the cloud model. So propulsion says there's enough here, and the way this acted the last couple of weeks, that you actually do have a sell signal. So this is something that if you've been long the name, you could take some off. There's nothing with taking some off the table. In fact, if you look where we're currently trading, we have not been at this level since July. So you have almost 6 months of buyers who are currently trapped. So I don't have a long-term view on this, but I would say just over medium term, should have some resistance overhead, and this could easily get down to 240. So I don't love it up here, and you can see a very solid MACD sell signal. The two lines are pulling away from each other, so you are increasing downside momentum. Next name is Nike. Nike's been flying and is on all-time highs, so I've got nothing bad to say here. I've got no upside targets in this time frame either, so I even have to go to a monthly to see. So we're on a monthly 8. I'm definitely holding the name. I may add to it down near 129-ish, but nothing bad here at all. McDonald's. Let's get to it. Here's a weekly chart. So we did take out the highs, but then we've traded down and we're beneath. Notice here, support level against what could be, failed bearish signals are good bullish signals. So we are holding against this level here of 207.49. We haven't closed beneath it. We haven't closed beneath it. Not only have we not closed beneath it, but we haven't closed beneath it properly. So it's holding against support. And I'd say anywhere from here down to 205 is support. So I'd be, this is a place that if you wanted to buy in a pullback, something you might want to consider. We've got only time for another one or two. Let's try Starbucks. Starbucks, look at how this thing turns on nines, weekly nines, 9 high, 9 high, 9 low, 9 high for a 2-week pullback. And here's my little timer saying we're out of time. And we've got a 9 now with an 11. So within a couple weeks where we've got propulsion exhaustion signal, kind of don't want to be a buyer here just based on past results. I'd say, Starbucks it's moved up a fair amount. If I had a place I want to buy it, it's much closer to 91 to 90-ish or so. So I don't want to be paying 101 up here to first get long. That is going to be it for this week. Sorry that we couldn't get to more names, but that's just kind of how it goes. And I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.